Hello, listeners. Welcome to the Morning Market Update, the podcast powered by AI. I'm Joe.
And I'm Sarah. Today is Tuesday, February 10th, 2026. We've got a massive amount of data to move through this morning, from a surprise cooling in retail to big moves in the tech and luxury sectors. Let's dive in. To start us off with the US markets, it is looking like a tech-led charge is keeping the momentum alive. The S&P 500 and the Nasdaq are both eyeing fresh rallies this morning as big tech continues to prove its resilience. The Dow Jones Industrial Average is coming off a session where it notched back-to-back records, largely propelled by Nvidia and Microsoft. Interestingly, we saw Oracle jump nearly 10% and Microsoft advance about 3%, showing that the appetite for software and infrastructure is far from sated. However, the big story this morning is the fresh retail sales data. It came in weaker than analysts estimated, and while that might sound like bad news for the economy, the market is viewing it as a Goldilocks signal. Treasuries extended their gains immediately after the report because it reinforces the case for the Federal Reserve to resume interest rate cuts later this year. Essentially, traders are betting that a slightly cooler consumer might be exactly what the Fed needs to see to loosen the reins. On the downside, we're seeing some drag in the consumer staples sector. Coca-Cola shares took a hit following their earnings report, and Marriott missed expectations as business travel felt the pinch of recent airport delays. In the small-cap space, the Russell 2000 is sensitive to these rate cut whispers, so keep an eye on those interest rate-sensitive stocks as the day progresses.
Moving north to Canada, the TSX is navigating a bit of a tug-of-war between commodity prices and domestic economic outlooks. Oil has been holding on to its recent gains as traders keep a very close eye on the Middle East, particularly with the U.S. advising ships to steer clear of Iranian waters. For the TSX, which is heavily weighted in energy, this geopolitical risk premium is providing a floor for prices, even as we see long-term pressure on crude. We also heard from Frances Donald, the chief economist at Royal Bank of Canada, who shared a pretty sobering outlook on Bloomberg. She's calling the current environment jobless growth for North America. She expects that U.S. and Canadian growth in 2026 will be driven more by government spending and capital expenditure rather than a massive surge in hiring. For investors on the TSX, this means we might see productivity gains in the industrial and tech sectors, but we should be cautious about consumer-facing sectors if the labor market remains stagnant. We are also seeing some interesting movement in the materials sector. Traders Greenwich Metals and Element Alpha are in the final stages of a merger, which could signal more consolidation in the commodity space.
Looking at the international picture, Europe is having quite a morning. The big winner is Kering, the parent company of Gucci. Their shares soared as much as 14% at the open, which is their biggest jump since 2020. This comes after better-than-expected sales at Gucci and high hopes that their new CEO, Luca de Meo, can really turn the ship around. In London, Barclays is also making headlines, announcing they plan to return at least £15 billion to shareholders through 2028. This move is part of a massive cost-slashing and profitability plan that seems to be winning over investors. Over in Asia, it was a mixed but generally positive bag. In Japan, the Nikkei was lifted by what traders are calling the Takaichi trade, while in Hong Kong, we saw a massive surge in drug stocks. Investors in mainland China have been pouring money into Hong Kong-listed pharmaceutical and biotech firms through the cross-border trading link. Meanwhile, the Nifty 50 in India continues to benefit from the broader emerging markets rally. Emerging market stocks hit their highest levels since late January as jitters over AI spending began to ease. In the currency markets, Alphabet, Google's parent company, is doing something quite rare. They are selling sterling and Swiss franc-denominated bonds, including a 100-year note. It's a bold move that shows just how much liquidity is being sought by the tech giants right now.
Now, let's drill down into some of the major North American corporate stories. First up, Spotify is the talk of the town. Their stock popped 10% after reporting incredible monthly average user growth. They're coming off their best Spotify Wrapped season ever, which has translated into a significant earnings beat. It's a clear sign that their pivot toward diverse audio content is paying off. On the other side of the coin, we have Marriott International. They missed their fourth quarter expectations, and they're blaming it on a drop-off in business travel caused by recent U.S. government shutdown threats and airport delays. It shows how sensitive the hospitality sector remains to domestic policy stability. Speaking of policy, keep an eye on Vistra. This nuclear giant in the S&P 500 is rising after a bullish upgrade. Analysts think the market is still underestimating the demand for nuclear power to fuel AI data centers. Finally, Coca-Cola is seeing a sell-off today. Despite being a safe haven stock, their earnings didn't quite provide the guidance investors were looking for in a high-interest rate environment.
Switching gears to international business, the energy sector in Europe is seeing some major shifts. BP has officially suspended its share buyback plan. This is a direct reaction to oil prices dipping below the $60 a barrel mark for the first time in nearly 5 years. While they hit their profit targets, the pressure from lower crude prices is forcing them to be much more conservative with their cash. In the banking sector, UniCredit CEO Andrea Orcel has signaled he's open to another term. He's been credited with transforming UniCredit into one of Europe's most profitable banks, so the market is viewing his potential stay as a sign of stability. We also have a very unique story from Italy. The Vatican Bank has launched 2 new stock indexes based on Catholic values. These indexes will filter companies based on Catholic principles, offering a new avenue for ESG-focused investors. And finally, back to the luxury space, the 14% jump in Kering isn't just a win for them. It's lifting the entire CAC 40 and the broader European luxury sector, as it suggests the luxury recession might be nearing its end.
To wrap up our deep dive, let's look at the broader economics and geopolitics. The Federal Reserve is clearly the center of gravity right now. That retail sales miss we mentioned earlier is fueling a narrative that the Fed may have more room to cut rates than previously thought. This is why we saw treasuries climb and the dollar soften slightly. However, geopolitics is adding a layer of complexity. President Trump has turned up the pressure on Cuba, leading the country to announce that international airlines can no longer refuel there. This follows threats of tariffs on any country supplying Cuba with oil. This kind of trade-focused diplomacy is creating ripples in the airline and energy sectors. Furthermore, tensions are rising between the UK and China. Beijing has lashed out at the UK's expansion of a visa scheme following the conviction of Jimmy Lai in Hong Kong. This diplomatic friction often precedes market volatility in firms with high exposure to Chinese trade. In the crypto world, Bitcoin is currently behaving more like a tech trade than digital gold, according to Grayscale, as it hovers around the $60,000 mark amid these macro shifts.
So, what are the key takeaways for today, February 10th? First, the AI trade is still very much alive, as evidenced by Oracle and Microsoft's performance, but investors are becoming more selective, looking for companies that can prove their earnings power. Second, keep a close watch on the Fed. Bad economic data, like the retail miss, is currently being viewed as good news for the stock market because it implies lower rates. Third, the luxury and banking sectors in Europe are showing surprising strength, with Kering and Barclays leading the way. And lastly, geopolitical tensions in the Middle East and the Caribbean are keeping energy markets on edge, even as prices face downward pressure.
That wraps up today's update. I hope you gained useful insights into how these global pieces are moving together.
Add your thoughts in the comments and be sure to follow us for more updates like this. This is Sarah.
And Joe, signing off.